Greetings. I wanted to do a shorter video of a topic that I alluded to in the previous one, basically regarding NAV erosion and return of capital in high yield investment funds. Again, this is specifically something that comes up frequently when discussing the Yield Max, Roundhilll, Defiance, and some of the other high yield funds. So return of capital and NAV erosion are not the same thing. There are many reasons why a distribution might be tagged as return of capital. Many of these are related to tax preference, how the distribution is treated. There are categories for when these distributions are made, and anything that doesn't fall within a specific few categories is often just tagged as return of capital. One reason there may be unrealized gains to account for, but fund management doesn't desire to close the position yet. So they're distributing ahead of time. It might be associated with projected incomes for the year. The fund doesn't know exactly what they're going to make over the course of the year until you get to the end of the year. So they may have a schedule or calendar of distributions or some goals or targets they want to make, kind of indifferent to the source of those distributions. And so there may be a distribution that is associated with that gets trued up at the end of the year. So you may get a distribution that's tagged as return of capital, but when they do the final accounting at the end of the year, it may be more or less that's allocated to that. Something we generally do see is the fund has earned less than it is distributing. This is historically kind of generally considered destructive return of capital. But again, when the fund is sending out more than it has earned, that is going to reduce the net asset value. There's a couple of links I've posted here. They were posted in the previous video as well. One's at Seeking Alpha, one's at Fidelity. I think they're both really, really good. I will post those in the comments, so you can just kind of hot link and look at those. NAV erosion itself, again, the second bullet item here, return of capital will reduce the NAV, but it may not always be an actual erosion. The NAV may go down, but in exchange, you got a portion of your money back. That's just a transfer of where that capital is, and you can choose whether to redeploy it back into the asset you were invested in, the fund you were invested in, or to go do something else with it. Typically, return of capital reduces your cost basis in the fund. Should not be a taxable event. It's basically just giving you your money back, right? Dividend payments, of course, do reduce the NAV, but these are not NAV erosion, right? If you're invested in the fund and it has gains that it would normally consider something that it would distribute through the course of a month or a quarter, the NAV may increase, but then they take the portion of that's supposed to be a distribution back to the shareholders. That's not really NAV erosion in modern investment vernacular. That's the way these funds are supposed to work. You may have NAV erosion from the loss of value in any underlying asset. So if they have a long stock or synthetic position that loses money, that will reduce the NAV. Long bond holdings. So if the value of the bonds goes down, a lot of these funds hold a significant amount of assets in cash and treasuries in particular. The value of those changes, that could affect the net asset value or any other asset that they're holding. Actual trading losses, of course, can reduce the value of the fund, the NAV. Also, local currency fluctuations. So again, I've got a link here that Roundhilll Investments has at their blog. Highly recommend this read, and it's another one I will post in the comments. I think another key thing is that people need to know what they're getting into in these funds. I think a lot of people see these high yields being posted and like, oh my gosh, I got to jump in on that. And I think it's very, very important to understand that different funds, different fund families are structured differently. Read the prospectus. If you don't understand the product, it may not be right for you. Yield max, for example, is just what it says. Yield max. It's not NAV max. It's not value max. Jay at Zega, who is the fund sub manager, has directly stated this. So they are going to sell covered calls and they are going to distribute the premiums. They may not be netting out the premium gains against losses in the underlying. And so that's where you may be seeing some NAV erosion, even though the distributions may look really good. I've put a link here as well. Again, it'll go in the comments. It's a great interview that was done on the Live Off Dividends Now channel. Uh, Recommend subscribing to that. Jay has made himself available to a lot of these fund managers, as have some of the others, but he seems to be the one that's out there the most. And I don't think he's misrepresenting the goal of these funds at all. I think he's been pretty upfront about what someone should expect. As a result, it can consider hedging your position in these funds. They're generating yield. They're selling the covered calls. Their prospectus, they are selling the covered calls. Their fund strategy and in the prospectus says nothing about having hedges on. And in fact, and again, this is referencing some comments Jay made, um, they have regulatory limitations on various things. They can only have a percentage, I think he says 25% invested in a single underlying asset and associated products. So, they're constrained on how much of the fund they can have actively invested in things, which limits how far out they might be able to go for their synthetic position. And it also limits their ability to maybe add additional strike prices or add a hedge because the value of all of those is aggregated. Uh, they don't get to net difference those out. So again, consider hedging your own positions in these funds. And again, if this may not be the right product for everybody. One issue related to hedging positions in these funds is while options do trade on them, the volume is very low. And as a result, the spread can be very, very high, in the bid and the ask. Um, so that's just something to be aware of. There may be other ways to consider hedging, perhaps with the underlying asset itself. Each of the fund's websites should have an area where you can go and check and verify how much of any particular distribution was for that period allocated to return of capital versus actual distribution of profits, for example. We'll use yield maxes here as an example and TSLY. Again, I'm not picking on either yield max or TSLY here, just using this as an example for expediency. But if you go to yield max sites, you go to our ETFs, go to TSLY, you'll get to this page. Scroll all the way down close to the bottom here and see the section here, supplemental tax. If you click on that, you're going to get to this page here, which is going to have a lot of tax and distribution notices. These monthly distribution notices are called 19As. If you click on, I think if we look at March is the one I'm using in the first example here. Yeah, March 8th, 2024. If you look at this, you'll see the total distribution was a little over 81 cents. If we go up here, net investment income, only 6 cents of that was investment income. The rest of it was return of capital. So a little over 75 cents of that distribution was return of capital, about almost 93% of it. And if you look in these last two columns here, you can see the cumulative distributions and percentages for the year to date. Okay. We go to April. What you'll see here is you'll see estimated net investment income, 68 cents. 100% of the distribution was investment income. One thing to keep in mind is that, these are estimates in a way. They're doing these distributions on a month-to-month basis. At the end of the year, when all of the accounting is done, some of this may be reclassified. So that's just something that's important to keep in mind. Personally, I think it's really important to understand what these funds are doing and to genuinely look at total return. I feel like a lot of people want to gloss over total return because these high yield dividend payments just look amazing. But at the end of the day, for every dollar you're putting into one of these funds, if they're making and distributing to you 60 cents on one transaction, losing an average of 10 cents on the other, and then giving you 30 cents of your own money back, your total return is going to be disappointing compared to the net distributions that you're expecting. To do a little backtesting example, and we'll look at this at Portfolio Visualizer, we're going to go to settings and we're going to make sure, okay, reinvesting dividends. So for purposes of this example, we are not reinvesting dividends, okay? We'll go through, do the quick analysis here. We'll go to the relevant portion. So if you see here, your $2,000 invested when this fund was started would now be worth $567. Now, yes, you got paid distributions along the way, and we'll take a look at that. But I think this is really, really important. We go to annual returns. So you can see you've got your balance here of $567. You have income over here, though, right? You have income, 2024, as of when this report accounts for it, $351. In 2023, you got $849. That's $1,200. So if you add that $1,200 to the $567, you basically end up at $1,767. So your $2,000 investment is still down $233. Okay, so you're roughly down about 10%. You'll hear people say, "Oh, well, reinvesting the dividends is the key," and I think there's some caution here, because if you're continuing to reinvest dividends in an asset that is losing money, you're still just going to be losing money. And if we compare this here to if you would have just bought Tesla, the underlying, your balance would be, you'd have $2,165. Now, no, you would not have generated monthly income or even an annual income off of that, but the net amount of money you would have would be higher. Now we're going to look at this having reinvested the dividends. So having done that, your $2,000 that you originally invested would now be worth not $567, but $1,678. So you're still down, only now you're down even more. You're down $322. Go all the way down here to the annual returns. So you can see here, yes, you've generated more income by having in an ever increasing number of shares. However, you're continuing to invest those shares in a fund that in this case, and again, I'm not picking on this one, that in this case has continued to go down in value. So the dividends you were earning, that's great, but you're investing them in an asset that was continuing to drop in underlying price. Okay. So you end up being down overall almost 20% roughly. So again, your initial $2,000 investment, even after all the dividends, repurchasing additional shares, your balance is still only $1,678. And keep in mind, you're going to have investment returns that are likely taxable unless you're trading in a tax sheltered account. So trading this in your Roth IRA, probably totally fine. If you're trading this in a taxable account, you may be in for a surprise at the end of each year. Going over to Seeking Alpha and just doing a quick confirmation of the numbers we're talking about here. If we go back, let's see, we got to go back 3 years. So if you look at just price return on the fund itself, you'd be down 70% in value, right? Started at $20 a share. Okay, remember TSLY's one that did a reverse split. So they did a 2-for-1 split to preserve the value. Lots of reasons to do that. Making sure they stay listed on the exchange, making sure they don't get dropped off of lots of different lists, making sure that margin requirements don't get altered. If you drop below about $5, that can become an issue. I think Jay mentioned some of that in one of the interviews. So if we go over to total return, let's think about this in terms of the original TSLY shares were purchased for $20, dropped in value. They did a 2-for-1 split. So each share now originally was $40. I believe TSLY's trading around $12. So each one of those is equivalent to about $6 left over from the original 20. You add in the $12 in distributions per share that have been sent out since. You get about $18 a share. It's a little less than that, I think, at the end of the day. 20 down to 18, you've got a 20% drop in the underlying, accounting for the dividends. Again, that's not reinvested. Now, I know that someone may point to Coney, which has an underlying of Coinbase, and say, well, I've gotten dividends back sufficient to cover my initial investment. And that's true as long as you did not reinvest dividends. If you were reinvesting dividends, there was a period of time with Coney where you would have been buying shares as high as, I think, around $26 a share. I could be wrong on that. I'm not going to take time to pull it up and check right now, but I think you get the idea. So you would have had shares that you bought at more than the initial offering. And so you'll still be underwater on some of those shares until a few more dividend cycles, a couple more dividend cycles probably pay out. So again, just the details matter. Total return absolutely matters. So anyway, the general disclaimers: none of this is investment advice. It's just for illustration, discussion, and education purposes only. Anybody have any questions? Have some other thoughts or different perspectives, feel free to email me questions at financialfreedommedia.com or put them in the comments, and everybody can see those, and we can have a conversation. Until next time.